In June 2020, the UK Prime Minister Boris Johnson announced major reforms to our planning system, which will give greater freedom for buildings and land development without planning permission. This creates a great opportunity for property developers with cash in the bank, but what about the rest of us? Hi everyone, this is Ash Ajaz, and in today's episode I will tell you all about development loans and how they work. Let's get started. Development finance is a short-term secured loan used to fund the purchase and build costs associated with a residential or commercial property. These include new builds, conversions, and refurbishment projects. The term of a development loan is normally between 3 and 24 months, depending on the lender. Development funding has two parts. The first part of the funding is used to purchase the land or an existing property. The second part of the loan is used to pay for the build costs. This part is normally funded in stages as the project progresses. Depending on developers' experience and the level of build cost, this may be subject to an independent monitoring surveyor signing off the work. Also keep in mind that this part of the loan is funded in arrears. Amount you can borrow depends on three key factors: current value of the property before refurbishment or value of land, build costs, and the value of the completed property once all the works are complete, known as gross development value or GDV. Each lender has its own parameters, but most commonly you can borrow up to 75% of current value and up to 100% of the build cost. Development finance lender will charge interest rate normally quoted as a monthly rate, since this is a short-term finance and can be repaid anytime. Rates are typically between 0.5 and 1.5% per month, and they're payable in either one of three ways: either monthly payments, deferred to the end of the term, or retained, meaning taken from the advance at the start of the loan. With some lenders, you can combine these three options. In addition to the interest charged on the borrowing amount, there are fees which you will need to pay. These include arrangement fee, normally between 1 and 2%, administration fee, valuation fee, legal fees, broker fees, and with some lenders an exit fee or an early repayment charge. If the lender requires you to have an independent monitoring surveyor, then you will also pay for their fees. When taking a development loan, you need clear exit strategy. Most common are sale of property or refinance to a term loan. This is vital to avoid hassle when the development loan comes to an end. It is very important to understand the pros and cons of any financial product you are considering. Some of the pros of development finance are ability to raise capital for the build costs, fast access to cash, and it can be used to pay for contractors and materials. Some of the cons of development finance include high cost of borrowing, security against your property, and you may be required to contribute a large sum at the start, since interest may be retained from the advance and the build costs are funded in arrears. So guys, this was my guide to development finance. Hope you found it useful and have a much better understanding now. Please be sure to check out some of the other helpful videos on this channel, subscribe to this channel, and thank you for watching.